Hello, everyone, and welcome to today's webinar. Today, we're going to talk about the Ford pension and how tariffs can impact the pension. Tariffs have been in the news a lot these days, and not only are they impacting financial markets, but also retirement planning. Today, I'm joined by my esteemed colleague, Michael Lee. Myself and Michael have decades of experience in getting clients to and through retirement. As a reminder, we are not employed by Ford Motor Company. We are not sponsored, endorsed, or affiliated with Ford. We are fiduciaries, which means we put your interests first and represent the interests of Ford employees. Our team is unique and we are structured to support employees at Fortune 500 companies and thoroughly understand their retirement plans. As an aside, my wife works for Ford. A lot of my friends work for Ford. So Ford's very personal and near and dear to our hearts. We live in Michigan, and so understanding the Ford plan is something that's important, not only for our family, but also hopefully for yours as well. Well, with that being said, let me turn it over to Michael to get things started.
All right. Thanks for joining us, everyone. As we dive in today, I want to thank Alex for running through the intro. It's just some points I want to highlight one more time. So, everything you hear today and anything you will hear from us in the future comes from a fiduciary standpoint. This is something that should be standard, but it's not. So, whenever you get financial advice from anyone, always check, is the person you're talking to a fiduciary? Again, this means that they have your best interest first. They must legally work in your best interest, not the company, not their company, but you as the client. Our secret sauce is that we know the company benefits inside and out. That's what makes us unique and where the name of our team comes from. Our team called the Focus Team at Farther focuses on specific large employers in the US. Last but not least, we are a comprehensive wealth management firm, which means everything that we do, scope of work includes tax planning, estate planning, relocation, company benefits, pretty much anything money related, we can be your go-to person to help with. Now, as we dive into the meat of the presentation today, we'll be going over the Ford General Retirement Plan, commonly known as their pension, which has seen lots of changes over, its decades and decades of existence. The most recent changes are very in line with what, the country as a whole has been moving towards, which is away from pensions. So Ford has grandfathered certain employees in. They've got a lump sum offer to really kind of buy people out, as well as capping the number of years that count towards your pension. These days, if you get hired, you don't even get the pension. You just kind of get like a enhanced 401k uh, contribution, which we'll talk about, in our 401k session. But today we're going to focus mainly on the Ford pension plan. Now, if you're listening to this, you probably are someone grandfathered into this plan. And we'll go over what this really means, everything from the formula to the retirement thresholds to some of the common questions that we get from folks. If you have any questions throughout our discussion today, feel free to throw them in the chat and we'll answer them as they show up. And we're going to dive right in. So, when we talk about the Ford General Retirement Plan, the pension is made up of several components. There's the flat rate benefit or the contributory benefit. You can think of it this way. The flat rate benefit is what you get if you have never contributed to the plan at all. For years where you contribute, you're going to use the contributory benefit and you're using one or the other. Now, contributing to the pension is a personal choice. You don't have to do it, but it always enhances the formula. And whether you decide to put money in versus just taking the flat rate benefit, that is something you get to decide as an employee. You take these two components, you're going to multiply that by your credited service. So think of it like I've been at Ford 20 years, 30 years, 40 years. That is that component, like how long you've been here. And what this creates is the basis for all of your payouts, which is the single life annuity. Again, if you have any questions, feel free to put them in. I think I saw one flash through. Alex, you want to take that one?
Yes. So the first question I see from the audience is, where do I find out more information about the pension? So this is a good question. So two different options where you can find additional information about the pension. You can do that online through your Ford portal site. So if you navigate to that, you can find uh, estimates about your pension and how it works. Another source you can find additional information is the National Employee Service Center. And we'll put the number into the chat, but the phone number for that is 1-800 248 4444. And you can get verified there with your Social Security date of birth, and they can also give you information about your pension estimates on different retirement dates as well.
Perfect. Thank you for taking that. So yeah, this is an internal function, so feel free to use those resources to get your exact numbers. What we're going to talk about here is just in general how the plan works. But again, feel free to chime in your questions as we go throughout today. So we'll have to dive into each of these sections one by one to get a clear understanding of each component. So flat rate benefit, again, is the benefit you get if you do not ever contribute to the pension yourself. This is a set dollar amount multiplied by your years of service. And this is what they mean by flat rate. They just kind of multiply that through. It's somewhere between 46 to 47 bucks per year of service. On the right-hand side of this chart, you will see what they think of as the early retirement age reductions. You'll notice that this kind of disappears, or 100% is shown when you hit age 62. So the easy way to think about this is you will get 100% of your flat rate pension as long as you're age 62 or older when you start your pension. You're allowed to take it earlier. And some people that have been at Ford their entire careers do get to retire earlier than 62. But you can see there's just haircuts or reductions that they'll strike against you for the pension if you choose to do that. Now, keep this in mind, pensions are um, designed to be retention devices. So this is not in a way to punish you, but really to give you milestones to encourage you to work for the company longer, where you become more valuable, more experienced. They just want ways to keep you around. It's not because they, enjoy giving away extra payouts. It's definitely not because they are looking for ways to, increase payments or increase costs to the employer. But just in a sense, this is a milestone or a retention device to keep employees on longer. Now, the flat rate benefit's pretty straightforward. The contributory benefit is where there's several moving parts. So we'll have to define some of these terms. So Social Security wage base is the first term you'll need to know if you're someone who is contributing to the pension. This is currently around 170,000 a year. It's the line in which they stop charging you FICA on your pay stub. So because of some legal limits, Ford is allowed to give you a bigger percentage multiplier on every number below that, and a smaller one. So this is the Part B, 0.4% on amounts above that threshold. This highly compensated employee rule is to make retirement plans like pensions a little bit more uh, equitable for everyone involved. So you'll notice on the right-hand side, after you understand what Part A versus Part B means, that the age penalties actually have different thresholds. So your Part A benefit, which again is the years in which you contribute, where you made under the wage-based limit, again, that's about 170,000 a year right now, you will get 1.5% of that, and you get 100% of what that accrues to once you get to age 62. But if you're a highly compensated employee, you can think of it this way, the company wants to retain you even more, right? They pay you more because you're more valuable. They want to retain you even harder than most other folks. The age to get the full benefit for that chunk of your contributory benefit is 65. And it's going to be prorated to each month, dependent on the number of years found under each part. So understanding how this works It's not always so straightforward as to when you can get full pension when you retire. So understanding if you have any years where you qualify for a section under Part B or whether you contribute at all is a great way to understand, what year do I have to work to get my full payout. Um, Now, before I move on to the next section here, it looks like we had another question come in. Alex, can you read it off to me?
Yeah, so just follows up on what you were just talking about. So, audience member asked, I haven't been contributing to my pension. Does it make sense even though I'm close to retiring?
Yeah, so that's a good question. So you get the choice every year, every day of like, do I want to contribute to my pension? And like any type of retirement savings, it would have been cheaper and more valuable to start contributing when you were younger, right? It gives the money time to compound and grow. In how the Ford pension works, it's a percentage of your pay they're taking away. And frankly, you were paid less when you first started. So getting those contributory years knocked out early on is definitely extremely helpful. Now, even if you're close to retirement, let's say you're 2 or 3 years out, and you think, well, I'm so close right now, does it even make sense? The answer is yes. Every little bit helps. It could have helped more if you did it early on, but the contributory pension benefit is always greater than the flat rate. So it never hurts, even if you're only doing a couple of years here and there. It always increases the payout. So if you're someone who is looking to make sure you're well set for retirement and you're looking to make sure you do everything you can, this is a lever that we do think it is worth pulling on. If you want to dive into your specifics, Alex and I a lot of times will actually review the exact numbers of what it looks like in a paycheck difference versus the pension difference by walking you through your pension estimator and helping you run these components. There's no cost for that type of consultation, but generally we do find it helpful. And no one has ever told us, after all these years, no one has ever said to us, Mike, we saved too much for retirement. What do we do? It's always quite the opposite. So we think it will be helpful. Okay, so as we go on, now that we talked about the contributory benefit, we need to talk about the supplemental allowances. So I mentioned earlier, pensions are designed to be retention devices. So the magic number occurs for most people right at 62, but Ford in this pension plan also has early retirement supplements, which are like in the opposite direction, they are encouragements to get you to retire early. You want to think of it this way, the early retirement supplement, which is people that have more than 30 years, they're going to give you an extra annuity, so an extra monthly payment, or an extra chunk of lump sum, as long as you retire before the age of 62. This is almost a way to kind of counterbalance the penalties if you have done at least 30 years. This is like an encouragement or like a waiver of the penalties. They basically give you some of this back in this supplement. Now, if you have an interim supplement, which means you don't have the full 30 years, uh, it's less. You can still qualify for it, but a lot of times it's not enough to outweigh the full reduction of the penalties. So this is a personal choice. There are encouragements built in if you've been at Ford a long time to be able to retire earlier. But if you work longer, you contribute more. Yes, the pension is just more money. It's a personal choice every person makes as to whether the time is more valuable at that stage of life or whether the money is more valuable at that stage of life. And, the answer becomes clear for everyone at some point. But this is basically the trade-off, right? You can work longer, put more money in, and your pension gets bigger and bigger, but you have less and less time to enjoy it, unfortunately. So something to think through. But again, Ford does have what's called early retirement supplements or supplemental pensions, which encourage early retirement. Now, on the payment options, I want you to imagine this is usually everyone's favorite part of our presentation. You've done 20, 30, 40 years at Ford. And when you get to the point of retirement, they say, congratulations, thank you for the time. We appreciate your service. How would you like your money? So Ford gives you three main categories of payouts. One is the single life annuity, which was shown in the formula earlier in the slides. This is specifically a traditional pension where you get a set amount for the rest of your life. It's guaranteed against one lifetime. That's what the single means. So as long as you're alive, every month for direct deposits into your checking account, a set number. This amount is not inflation protected, meaning this is different from Social Security. It will not go up over time. So whatever the first check you receive is, it will also be the last check. Social Security goes up every year with inflation. Ford's pension does not. Now, this money, as you get it per month, is PBGC guaranteed. This stands for the Pension Benefit Guaranty Corp. This is like pension insurance that all companies are required to buy if they run a pension at all. How this works is if you outlive Ford, so let's say you're retired, 10 years, 20 years go by, you're in your 80s, but the company goes out of business. Maybe they go through bankruptcy or something like that, and they're unable to make their pension payments. Even in this situation, the government will step in and make those payments on behalf of Ford. So this is, in terms of guarantees, as good as it gets. Again, guaranteed by the federal government. Now, last but not least, taxes. Just like your paycheck, every time you receive a pension check, it will be taxed as income. This is just one of those things that are always true in life. So as you receive pension income, it is taxed at the federal level. At the state level, it'll depend. So depending on where you live, if you relocate, you will have to pay state income tax if your state charges it. Some states don't, some states do. And again, if you like fully disconnect, let's say you move to a different country, you would obviously not pay any state income tax since you don't live in that state at that point. But federal taxes still due because it's almost like Uncle Sam follows you around. But again, state taxes based on where you live. Now, single life annuity is the default option if you are single. The contingent annuity options is the default if you're married. The percentages here shown on the screen are actually what percentage your spouse gets. So typically what it looks like is while you are alive, your payment it's a set number that will be slightly less than a single life annuity. This haircut that you've taken to make it less is to basically equalize the payout they expect to give your spouse who may outlive you. Now, if you do 50%, that means your haircut will be smaller. When you pass, your spouse will get 50% of what you used to collect. If you go with 100 or any higher percentage, it means that you will take a bigger haircut, but your spouse would get 100% or maybe 75% of what you used to collect. The more you give your spouse, the bigger your reduction is. All the other rules are the same. So it's inflation, no inflation adjustment. It is PBGC guaranteed and taxable as income. Now, when you make this decision, it's a one-time irrevocable life choice. There's no redos. So understanding kind of your health profile, your family history, as well as your spouse's to understand, like your age difference, how long you expect to collect each one is key to making the right decision along the percentages, whether these lifetime payouts make sense or maybe even the lump sum makes sense. Now, the lump sum is the third choice where it's very different. Unlike the other two, you're not getting a monthly check. Ford will just give you a one-time check right when you retire to basically pay you out the entirety of the pension. This money is eligible for a rollover and there are no taxes until withdrawn. So rollover is a tax term. This is what we call it when you take retirement money from one account and move it to another. So you basically get the entire amount, move it to your IRA. Once it's in your IRA, you only pay taxes upon withdrawing from there. So if you, let's say your single life annuity was $1,000 a month, and when you retire, you take a lump sum, you move it to your IRA, and you take out $1,000 a month, the tax consequence is actually exactly the same in that situation. But with the lump sum, you get to choose how much you take out. So you could say, Mike, I want $2,000 a month, or I want nothing per month. This flexibility gives you more control on your taxes. So a lot of times this is popular for that control piece. This is also unique compared to the other two because it's investable and inheritable. Meaning once you get the lump sum, you can choose to buy stocks, bonds, gold, real estate, really whatever investments you want. It should grow over time. You can pay yourself out the interest, and anything you don't use, you can give to your spouse, you can give to your kids, your grandkids, your church. Pretty much you get to pick the beneficiary. This is a key difference with the monthly payouts because the monthly payouts, they'll guarantee you for life, but especially if your life is shorter than expected. Whenever you pass, the company just keeps the rest. There's no beneficiary payout other than your spouse, the contingent option. There's nothing that goes to your kids or anyone else. So again, lump sum is both investable and inheritable. Now, the lump sum, lastly, is subject to required withdrawals, meaning at one point, even if you don't need the money, taxes will be due because they're going to force you to withdraw it. And why is this important or why is that in there? I think it's best explained if I tell you a little bit of a story. If you came to me, Mike, and said, Mike, I'm in the ideal retirement situation, I'll never need my pension money. What does that normally look like? You'd be saying something along the lines of, Mike, I'm retiring from Ford and I don't need my pension. I'm going to do lump sum. And the reason that I can do that is because I've already gotten my inheritance. I have rental properties that are set up that are cash flowing positive. I have convinced my spouse to keep working while I'm going to be retired. Or maybe even a combination of all three. If you're in that situation, I would first say congratulations. You've done something right, and it means most likely you will not need to spend down your pension funds. But required withdrawals happen when you turn 73. Uncle Sam will basically come to you and say, "Hey, we've been waiting your entire life for our tax dollars. So even if you don't need the money, we don't care. We want you to take some out, pay us our tax piece, and you can reinvest it, you can spend it. We don't care what you do with the rest, but we want our tax dollars." So again, required withdrawals apply to pension lump sums. They apply to 401ks when you hit your 70s. They don't apply to the monthly payouts though. And the reason for that is because, well, Uncle Sam was collecting the taxes all along. So no need to force you to take money out, right? Or there's not even really an account to take money out from. So again, the rules are a bit different. We think this is a one-time irrevocable life choice. So it's a really important decision you need to make with you and your family. And there are pros and cons to each. So for the lump sum, we typically see people that pick the lump sum pick it because they want more control of the money from a tax standpoint. Maybe they have children and it's important to them to leave the money to the kids. You must have a little bit more risk tolerance because there is an investment component. There is some degree of risk involved that you got to handle and manage the money right. Um, but yeah, lump sum is typically favored for some folks because of those reasons. People that like the annuity are people that tell me they don't like any risk. They want like a set it and forget it type of thing. They don't like the responsibility of it. Or maybe they're just really healthy. Like you say to me, Michael, I run marathons for fun. I'm really healthy. My mom's 99 and still going. Like those are good reasons where like you can make an inference that you're probably gonna have a longer than average life expectancy, and thus you would want an annuity payment rather than a one-time lump sum payment. Both of these are based on standard life expectancies in the United States, which is around mid 80s for both men and women. Um, Again, I think I saw another question flash in. Alex, can you read it to me? And for the rest of the audience, if you have questions, feel free to pop them in the chat. We'll take them as we go. Go ahead, Alex.
Yeah, this is a really good question. So an audience member is asking, Which is more popular, lump sum or annuity?
Yeah. So we do know the answer to this. We want to say one thing first. We don't favor one or the other. They are supposed to be actuarial equivalents, which means, for the average person with the average life expectancy, it should end up being about the same amount of money in most cases. But there's definitely one that is way more popular than the other. And in all the companies, so pensions are pretty rare in the United States. Only one out of every 10 employers provide pensions at this point, and then only a fraction of those, one out of 10, even provide a lump sum payout. So the annuity is the traditional form of how pensions work. But for pretty much every company that we do this for, lump sums are the most popular choice, usually taken 3 out of 4 times. The remaining 1/4 of the time, we see people take some form of the monthly payout. Just depends. But again, we don't think just because it's the more popular choice that it means it's the right choice for you or your family. It's something that you need to think long and hard about because it's a one-time irrevocable choice. But again, lump sum's definitely way more popular. Okay, so on to the next slide. So if you're someone who is thinking of lump sum, there are some pieces here that are really important to understand, and it might answer this question. If you looked at your pension at any point in your career, you might have noticed that the lump sum starts to go up and down, and it, you know, just changes when you look at it at different times. And this is because when Ford does this calculation, it is swapping the single life annuity, which is a fixed component of the formula, into a lump sum. And this conversion actually has two additional variables that change over time. The first one is your age. So age is a big component because when they give you a lump sum, they're giving you a one-time payment, which should be equal to a lifetime of the monthly payment. So this is best explained with an example. Imagine both Alex and I, we work at Ford. Everything about our lives have been exactly the same. We have the same job title, the same pay, same career. We both did 30 years at the company, and we're both thinking about retiring. The only difference between Alex and I is I'm 62 and Alex is, let's say, 67. So when we both retire on the same day, Ford will say, congrats to both of you. Your pension is going to be $2,000 a month each. Now, Alex and I will both say, whoa, whoa, whoa. We both want the lump sum. And they'll say, okay. So since you both get 2 grand a month, and again, it's the same because on the annuity, this is a fixed formula. Our careers are exactly the same, right? So it makes sense it's the same. When they convert each of our $2,000 a month to a lump sum, mine will be a little bit bigger than Alex's. So let's say mine is $500,000 and Alex's is 400,000. The reason for this difference is because my life expectancy is longer than Alex's, right? Even though our pay is the same, the number of years of service, all those things are the same, I have longer to live. If I'm 62, they're expecting me to live for another 23 years. Since Alex is 67, they think he'll get another 18 years. So baked into my lump sum is 5 more years of expected pension. So again, the younger you are, the bigger your lump sum will be. The other piece that is going to be an even bigger rate of change here is the segment rates. So segment rates is another word for interest rates. This is the same interest rates you look at for mortgages, car loans, CDs at the bank that the Fed controls. It also affects your lump sum. The lower the interest rate, the bigger your lump sum will be. And the way this works is you want to think about it this way. Ford has to give you equal versions, right? Either an annuity or a lump sum. They have to be equal. So if you retire when rates are low, Ford has to give you more money to start with and get interest on, right? Interest rates are low to be the equivalent of whatever your pension is. Let's call it $1,000 a month. Now, if interest rates are really high and you retire and say, I want the lump sum, they don't need to give you as much to start with for you to generate, again, the same $1,000 a month in interest. So again, when you think of the lump sum, timing is important. Um, Age is a factor. Interest rates are a factor. Taking the pension out of the lump sum is timing sensitive, meaning you can pick days where there's more you get from the lump sum. There are dates you can pick that are less from the lump sum. If you want the monthly payouts, it is not as timing sensitive, right? You just need to know about the age penalties, the reductions, and hit your milestones. But from the lump sum standpoint, even if you hit all your milestones, you still want to pick a year in which you're ideally younger and interest rates are lower to get a bigger payout. Now, it seems a little bit like a guessing game. This is feedback we've heard before, but it's not. Ford actually publishes and tells you exactly what rate they're going to use every year. So the rate changes over on a calendar year basis. They always refer to the same month, which we've highlighted on the screen. You can basically time your pension picking out a year in which the rates are lower. So this will lead us to how tariffs are impacting your pension now. So tariffs, and this is something that's been in the news, are basically a country to country tax. An extra tax typically pushes the cost of goods up, and I think everyone at Ford knows intimately what that means. Typically leads to higher inflation, which would force the Fed to raise interest rates to combat the higher inflation. So tariffs have this kind of inflationary effect, interest rate increasing effect. And this is something that we're already seeing. So I'm going to go back one slide, that the rate has been trending up over the year. It'll get locked in August. So we're coming up on that now. And if rates go up, that means lump sums go down. So if you're someone on the cusp of retirement, this is one of those years where you want to be retired before the rate changes over. If it was the opposite situation, let's say rates were trending down. This has happened most recently during COVID where rates were near zero. Those were years where you could have cashed out your pension at a higher number if you just waited until the new rate folded in. So again, lump sums are timing sensitive, and tariffs, as well as any type of government policy, can greatly affect it. Um, Looking at both your age and the interest rates can uh, influence your pension decision. And if let's say things continue to get worse, right? It just means that the annuity options will look better and better because the lump sum option has been shrinking and shrinking. So again, it's not like all is lost. There is some degree of control you have over your choice of payout as well as your choice of timing. And again, this is exactly the type of stuff that we help with. Now, as we go through our concluding remarks, we'll open up for questions at the end. Thank you for listening today, everybody. You're literally on the first step of our process, which is this educate step. Alex and I go all around helping educate people on their benefits plans. We teach them about current events, the markets, your benefits to make sure you're using them to the best of their ability. If you like what you've heard and you want some one-on-one time, just like today's event, there's no cost for that. We will construct a plan for you, look at your accounts, track your expenses, walk you through your company benefits as an initial consultation. And this is something we do to help you prepare for retirement. The reason we do all this up front is because this is our way of meeting potential clients. And the only point in which you become a client and you say, well, what's the cost to this? Is if we're actually managing accounts for you. So as our firm clears through Fidelity, we can be your financial advisor even while you're employed. We can help with your 401k plans, any other investments you have, and basically handle your retirement for you. At that point is where we have to charge for our services, which is a management fee that starts at 1% a year. As a fiduciary, we don't take any type of commissions or transaction fees. This is a service provided through the Fidelity platform, so you actually keep all your accounts in the same place. But again, that's only if you wish to embark on that after you've done the consultation, done the education piece, and found it to be helpful. And this is right in our wheelhouse. Now, if you would be interested in moving forward on any of those steps, here's our contact information. This is how you would contact us, set up a meeting, and just move forward from here. Um, we're going to open up for questions. So again, feel free to throw them in the chat and we will take them as they come in. Alex, do you mind reading them off to me?
Yeah, so we did get a question. Audience members asking, I plan to retire in the next 10 to 15 years. Do you expect rates to go up or down?
Yeah, this is a good one. Interest rates actually change a lot based on current events. They swing. And with 10 to 15 years to go, I'm going to tell you that it's anyone's guess. It's just so far out in the future that so many things could happen. We could have another war start. We could have another pandemic. We could, go through a recession. There are so many things that moves it up and down that I'm going to tell you at 10 to 15 years ago, it's probably just too hard and something you should be watching regularly if that's your timeline. But again, it's not predictable with that amount of time to go. But I would say if you are someone that's like 2 or 3 years away, I'm going to tell you that it is trending up. The current policies are trending it up. And, even though the president has said, I want rates to be lower, it's not directly controlled by the administration. It's controlled by the Federal Reserve. So it's not just what, you know, the president says. It has much more to do with the central bank. That being said, there is definitely like planning components you can do to see if you can adjust your dates, compare exactly what the difference is when the rates change to see if, the additional time of, another year paycheck, 401k match, and that type of stuff outweighs the drop in the lump sum. Your mileage will vary because it depends on whether you've contributed, how many years you've been there. This is something that Alex and I would be happy to help you run the numbers and compare at no cost. But yeah, maybe if your timeline was shorter, it's easy to tell. But with 10 to 15 years to go, you know, anything can happen. Do we have any other questions?
I don't see any additional questions.
All right, that's okay. Any other questions we're happy to answer. Maybe they're just a little bit more private. So let's call it here for today. I want to thank everyone for listening today. Check out the chat box for the links to some of the materials and the questions we've answered. Um, we're looking forward to connecting with you. We want to thank all of you for listening today, and I hope you all have a great rest of your afternoon.